RBI గవర్నర్ మాట్లాడుతున్నారు. ఇప్పుడు లైవ్ చూద్దాం.
First of all, growth. As per the first advanced estimates, real GDP growth for the current year is estimated at 6.4%. The numbers were released by MOSPI recently. This is a softer expansion after a robust 8.2% growth last year. Going forward, economic activity is expected to improve in the coming year. Agricultural activity remains upbeat on the back of healthy reservoir levels and bright Rabi prospects. Manufacturing activity is expected to recover gradually in the second half of this year and beyond. Early corporate results for Q3, and we have more than 50% of the results now as we speak. It indicates a mild recovery in the manufacturing sector. Mining and electricity are rebounding from monsoon-related disruptions in Q2. Business expectations remain upbeat as evident from the PMI Manufacturing Future Output Index. Services sector activity continues to be resilient. PMI services, however, declined from its recent peak. On the demand side, rural demand continues to be on an uptrend, while urban consumption remains subdued, with high-frequency indicators providing mixed signals. And we are aware, we got the Nielsen survey report also just yesterday. Going forward, improving employment conditions, tax relief in the union budget, moderating inflation, together with healthy agricultural activity bode well for household consumption. Government consumption expenditure is expected to remain modest. Higher capacity utilization levels, robust business expectations, and government policy support augur well for growth in fixed investment. Continued buoyancy in services export will support growth. Global headwinds, however, continue to impact uncertainty to the outlook and pose downward risks. Taking all these factors into consideration, the RBI has estimated that real GDP growth for the next year to be at about 6.7%, with Q1 at 6.7%, Q2 at 7%, Q3 at 6.5%, and Q4 too at 6.5%. The risks are evenly balanced. Coming now to inflation, headline inflation after moving above the upper tolerance band in October has since registered a sequential moderation in November and December, standing at 5.2% now. Going ahead, food inflation pressures, absent any supply side shocks, should see a significant softening due to good Kharif production, winter easing as we witness every year in the vegetable prices, and a favorable Rabi crop prospect. Core inflation is expected to rise but remain moderate. Rising uncertainty in global financial markets, coupled with continuing volatility in energy prices and adverse weather events, presents upside risks to the inflation trajectory. Taking all these factors into consideration, CPI inflation for the current financial year is projected at 4.8%, with Q4, the current quarter, at 4.4%. Assuming a normal monsoon, CPI inflation for the financial year 2025-26 next year is projected at 4.2%, with Q1 at 4.5%, Q2 at 4%, Q3 at 3.8%, and Q4 at 4.2%. The risks are evenly balanced. I will now come to the external sector. The India's current account deficit moderated from 1.3% of GDP in Q2 of last year to 1.2% in Q2 of this year, 24-25. According to the World Bank, India with an estimated inflow of 129.1 billion US dollars continues to remain the largest recipient of remittances globally last calendar year 2024. The current account deficit for this year is expected to remain well within the sustainable level. As on 31st January this year, I may inform you, India's foreign exchange reserves stood at 630 plus billion US dollars. This provides us an import cover of more than 10 months. Overall, India's external sector remains resilient as key indicators stay robust. I would like to mention over here, and especially because there has been commentary in the media about the Reserve Bank's exchange policy. Well, the Reserve Bank's exchange rate policy over the years has remained very, very consistent. Our stated objective is to maintain orderliness and stability without compromising market efficiency. The Reserve Bank believes in the market efficiency of the markets that we have in India for Forex. Accordingly, our interventions in the Forex market focus on smoothing excessive and disruptive volatility. It does not target any specific exchange rate level or band. The exchange rate of the Indian rupee is determined by market forces, and we will continue with this policy. Coming now to liquidity and financial market conditions, I may state that after remaining in surplus from July to November 2024, system liquidity as measured by the average net position under the liquidity adjustment facility did turn into a deficit during December 2024 and January 2025. This drainage of liquidity is mainly attributed to advanced tax payments in December 2024. You are aware there are quarterly advanced tax payments to be made, December being that particular month. For the advanced tax payments for Q3, that did have an impact. Capital outflows, again, one has witnessed some capital outflows because of various reasons. Forex operations, and a significant pickup in currency in circulation as we witness every year in January. It has been, however, I would like to mention over here that we have observed that some banks are reluctant to on-lend in the uncollateralized call money market. They are passively parking funds with the Reserve Bank. I take this opportunity to all the banks to urge them to actively trade amongst themselves in this uncollateralized call money market, so as to make it deeper and vibrant for better signal extraction from the weighted average call money rate. The Reserve Bank is committed. I want to assure everyone that the Reserve Bank is committed to provide sufficient system liquidity. We have taken a number of steps in this regard, and we will continue to monitor the evolving liquidity and financial market conditions and proactively take appropriate measures. I repeat, proactively take appropriate measures to ensure orderly liquidity conditions as may be required for the system. And when I say liquidity, it means not only transit, overnight liquidity, but also durable liquidity to meet the requirements of the system. I now come to financial stability. The system level financial parameters for the scheduled commercial banks continue to be healthy. The credit deposit ratio for the banking system at the end of January 2025 was at 80.8%, broadly similar to that on 30th September 2024. Bank liquidity buffers are sufficient, though the net interest margin moderated. return on assets and return on equity are robust. The system level parameters for NBFCs too are very high.